Alright, hello everybody. Let's do a quick sound check and screen check. Can you hear me? Is audio fine, and can you see the slides? Okay, thank you. Alright, let's go right ahead and let's start off with the trade plan. Now, what I have been doing in all the webinars that we've been conducting here on FXStreet is I've been looking at the procedures of trading, which I believe are much more important than giving somebody some trading signal, to be very frank. Most of the new traders I'm talking about, I'm sure all of you are pretty experienced over here, but most of the new traders do not have a plan, and we've been covering the specifics of a trade plan earlier. We went over money management, the tools of trading, the Fibonacci ratios, support resistance levels, etc. Now what I'm trying to do is build it all together and understand what a trading plan is. I have seen, and believe me, I have seen that it's the trading plan which is often the thin line between success and failure. Alright, so let's go right ahead. My presentations they don't take too much of time, so let's just finish it, just concentrate on the important points and let's go right ahead. Alright, trading, first of all, let's just put it in perspective. Trading is all about management. It is not about technical analysis. It is not about trading signals. It is not about the best technical strategy. Trading is about management. Managing yourself, managing your money, your attitude and your position. And believe me, it's a fact. It's not about predicting where the price is going to go. It's not about forecasting where it's expected to go. It is not about having an opinion, oh, I believe the euro is going to be stronger down the line. No, you are here to make money. Today, you are going to be trading the setup for whatever strategy you're looking at, and for that, you need a plan. Now, generally, most novice traders, the new traders, fail to have a plan, and they fail even before they start trading. And the successful traders, the traders who really make money, do so because they have a trading plan. And a trading plan, of course, has to be with an edge which incorporates effective money management. You can't just have a trading plan and say that, okay, this is my plan, I'm going to enter here or I'm going to exit there. No, the trading plan has to have an edge. Obviously, there's something which is going to give you a high probability of success. Remember one thing, folks, we are in a business of probabilities. There's nothing else to it, and the more odds that you put in your favor, the better are the chances that you will survive in this market. Otherwise, as the statistics say, you know that most traders, 85% to almost 90% of the traders, tend to lose money over here. What I want to do is go over the factors which are important, which hopefully will avoid any trader to lose money, or at least show the correct path, the approach towards trading. Right? And for that, trade plan becomes really important. Now, having an edge, it's said, that's what they say, that if you don't know your edge, you probably don't have one. You need to have an edge in this market, and one of the main reasons why most people lose money in trading is the lack of a reliable trading advantage, which simply means that edge that you're looking for. And many traders do have an edge, but they are really not sure about what it is. You really need to identify that edge, and the best way to resolve this or ask yourself this is look at your own trading style. Now, do your methods or the techniques that you follow consistently place the odds of winning in your favor, or do you rely on lady luck to deliver profits? Now, when I say place the odds of winning in your favor, it simply means the odds. I'm actually saying the odds. It is never a confirmation. You will never get all correct trades, 10 out of 10. It's asking for the impossible in trading. This market is too huge. You just cannot control what goes on in the market. You need that edge. Your techniques, your methods need that high odds that place the winning in your favor. It's never a confirmation, or Do you really just rely on luck that, okay, I'm going to go long over here and I hope that it goes, I'll be quite lucky if it goes in my favor. And if it doesn't, say, oh, I was plain unlucky. I mean, I took the trade, but it didn't really work out. If that's what you're doing, then you are gambling. You're not trading. Then, as I have often said it, and I'll say it again, you have better chances of making it in a casino. Probably go to Las Vegas or somewhere. You'll probably have a good time. You'll have a couple of drinks, look at some interesting people, have a good time losing money. You'll still lose money, but you'll have a good time doing so. Why do you stress yourself sitting in front of the computer trying to fight the market when you don't have an edge, right? Right, now does your trading style follow a trade plan? That is more important. So your trading style, you have to ask yourself that do you have a plan? Let's just put something into perspective, and this is something which I get a lot from new traders. Do a lot of mentorship. We do personal mentorships, also coachings, different courses we offer. For new traders who come in, there's this question that they've been losing money. Obviously, if somebody's losing money, she wants to improve the trading, and they come over and say, okay, we want to learn some methods. One of the first things I really do ask them is that so far, whenever you've been trading, whether it's on a demo account or it's on a live account, did you have a plan for a trade? Was there a reason for you to enter the trade? Are you entering the trade just because the market is moving? And believe me, most new traders do say that they don't have a plan, and that is one of the basis. We'll just go over a couple of examples over here about what a trade plan should be. I want to give you the basics of what a trade plan should be, like the very basics. I mean, just the very basics, nothing very complicated. But the fact is, you have to ask yourself that when you do enter a trade, is there a reason for the trade? Do you enter the trade because your setup says that, okay, this is happening and this is why I'm entering the trade? Or are you just looking at the market, and once price starts moving, that do you just enter, oh, I'm missing out on the action and I want to enter the trade? You have to ask yourself that. And if you do have a plan, that means you have a reason to enter the trade. And if you don't have a plan, obviously you're just gambling. Just put it down as gambling. So what is a trade plan? Let's put it down to absolute basics. There's nothing complicated about it. In fact, for me, as you know, that keep things absolutely simple. Do not complicate things. So one is decide on a trading strategy. Could be anything. Could be entering on the crossover of a moving average. For those who follow indicators, I don't follow indicators. Could be crossover of a MACD signal line for all you care. Could be anything. Could be entering on a bounce of a support resistance level. Could be entering on the bounce of a trend line or break of a trend line. Anything. Fibonacci level, pivot level, anything. So a trading strategy has to be defined. You have to write it down that this is my technique, that this is what I'm going to enter the trade for. Obviously, once you have the strategy, then you need to determine an entry, a low risk entry, determine the stop loss level. This becomes a little ambiguous because a lot of traders I know of, they say that stop loss often becomes, it goes against you. Well, it's something very personal. I know some traders who are comfortable trading without stops. I would not advocate it, of course, but then it's a very personal thing. And determine the expected price targets. The simple fact is a trade plan must give you an expected price target. Most traders, when they do have a trade plan, I have seen that you have an entry and you have a stop loss level, but you do not know an expected price target. Now, when you plan a trade, obviously you need to know where price is going. Until and unless you do not know where it's going, how are you going to plan the trade? So you need to have an expected price target. Now, these can be determined by any technical tool. Could be a Fibonacci level, could be a pivot level, could be a trend line, could be a support resistance, could be a moving average. Price is expected to move to the moving average, and there I would probably take profits, whatever. But it is very important that you must have an expected price target. Now, once you have determined these give the parameters of money management. The risk to reward ratio and the correct position sizing. Right? We've gone over both these in pretty much detail. For those of you who want it, these webinars are recorded. They're there on FXStreet website. They're there on my website on London School of Financial Planning. So you can have a look at these. But this is very, very important, because once you have your entry in position, your stop loss, and your expected target. Obviously, you calculate your risk to reward ratio. Once the risk to reward ratio is correct, you can also calculate the position sizing. Position sizing simply means the number of lots that you would enter, or the capital that you would risk for this particular trade. It's very important that these parameters are determined before you enter the trade. All of these points that we covered have to be determined, written down before you enter the trade, not after. Now, once the trade is filled, this becomes part of your trade management. Your trade plan, remember, very, very important, your trade plan has to be written down, built, confirmed, determined before you enter the trade. Once your trade is filled, once you are in a trade, then it comes down to the trade management, which is also part of the trade plan. But this, let's just redefine this, let's call it trade management. So once the trade is filled, the rules for managing the trade, you should have these rules ready, written in front of you. What should you do if the trade goes against you? Now, this is something which most traders do not think about, or they do not want to think about it. It's a very natural human emotion that, oh, it cannot go against me. I mean, I'm doing everything correct. I've worked for this. My technique is good, so it has to go in my favor. No, this market is too huge. Anything and everything can influence the market at any given time. You may have the best trading technique. You may have done everything as per your rules, but let's just say for something, the US president says something, you say you're long on the Euro USD, and he says something and the US dollar drops at that particular instant. What do? You get caught in that. Maybe subsequently it might still come up in your favor, but at that time you were caught in it, your trade goes wrong. You have to have that probability written there, that what are you going to do if the trade goes against you. Of course, you do have a stop loss. It's very important. If you don't have a stop loss, this point becomes very, very important. But since you do have a stop loss, still you have to have that particular, I don't know how do we put it, what I call it as a pain level, that even before price reaches your stop loss level, there is a particular pain level I call, that if price reaches there, then I know that something has gone wrong with the trade, the momentum is not there, and I would probably get out of the trade. No questions asked. Not even to let price move towards my stops. As a trader, believe me, I've said this before and this is what we've covered. Your prime objective as a trader is to conserve your capital. Period. No capital, no trading. All your techniques are should be geared towards the fact that your risks must be as low as possible. So you have to have that plan that if the trade goes against you, what are you going to do? And of course, if the trade goes in your favor, what should you do? Determine certain technical levels where one can take interim profits. Determine how and when to move stops in your favor, not against you. Right? Now, most traders, isn't it a fact that everybody says that the trend is your friend and let the profits run and cut your losses? But usually this does not happen. It happens absolutely the other way around. And let me go over some trade examples and we'll go over. This is a very important point. Right? Executing the trade plan. Now, looking at all these points, I can seriously tell you that there is no secret to success. As I've said before, traders who make money do so because they have a trading plan. And then they have the discipline to execute it flawlessly and to accept the money that the markets give them, or the losses for that factor. I think I should change it over here, and to accept the profits and the losses the market gives them. You have to accept both of them, take both of them in your stride and move forward. Now, implementing a trade plan, this is something I have seen with successful traders, and it's a fact which a lot of novice traders really don't follow, or they just don't understand this concept. If you were to ask somebody where he thought the market is going to go tomorrow, he would probably say, I don't care. Let it go wherever it wants to go. I am following the market. Right? You are not here to predict price movement. You are not an astrologer. You are a trader. You are here to follow the price. So it's the implementation of your trade plan that is a bigger challenge. It is it. Human emotions play a large part in trading. I've often talked about the 3 M's: money, mind, and method. Where money constitutes about 5 parts out of 10, money management is very important. Mind factor is this discipline to execute a trade plan, to stick to your trade plan, and the patience to wait for your setup. That's a mind factor. That takes up about 3 parts out of 10. And the method, that's a technical analysis, is the least important. Trading has a lot to do with human emotions, and this is one of the reasons why a trade plan is important. And there's something which one of my mentors, if you can call it, or somebody who had helped me a lot in my initial years ago, he had told me something very, very interesting, very nice, and I quite found it very interesting. Is what is the real need for a trade plan? And this is a question I asked him. I said, I obviously did not understand the importance of a trade plan years back, like any new trader. And he emphasized that you must write down some things before you. So what is important? There's something which he said which has stuck to me and is very, very important. That he says a trade plan takes away the emotions from trading. You don't start second guessing yourself. Of course, if you have the discipline to follow your plan. So once you have a plan, say that this setup has occurred and this is what I'm going to do. This is my entry, this is my stop, this is my target, this is my risk to reward ratio. You follow it 1, 2, 3, 4. You don't second guess yourself. You don't say, oh, I think I'll wait. Maybe this is not looking too good. Or let's wait for some time to give me a better entry. Or maybe I might not risk so much money. Or this looks very good. Let me risk 50% of my account over here. No. You have a trade plan. Your setup conditions are there. You follow it. Period. This is what it is. This is my entry. This is my stop. This is my exit. This is the capital I'm going to risk onto the trade. Period. I don't deviate from that. So a trade plan is supposed to take away the emotions from the trade. You don't start second guessing yourself. But easier said than done. Human emotions being what they are, you may not be able to follow. In fact, most traders do not have the discipline to follow it. Right? Now, this is the slides as far as we were concerned. This was a slide. So this PowerPoint is available at my website, London School of Financial Trading. You all know what it is. You can get this website, this PowerPoint there. It's just theory. I mean, it's really not important, but if you want it, you can get it there. Let's go over some trade examples here, right? Now, all our techniques have a specific trade plan. But now, whatever, if I'm trading the harmonics, I'm trading the divergence, I could be trading an Elliott wave, I could be trading a Wolf wave. Everything has to have a plan. And to be frank, we don't just teach. I mean, I walk the walk. We consistently make profits in our own accounts. And let me end with my favorite saying that trading requires the patience of a saint and the discipline of a soldier. Alright, so a trade planner. Let's go over some particular examples. Could you just confirm, can you see the charts? Charts okay? Has it come up on screen? Okay, alright. Thank you, George. Okay, now the first thing, as I was talking about, this is one of the things that everybody talks about. Let your profits run and cut your losses. Does it really happen this way? Let's take an example. Usually happens the other way around, absolutely the other way around. Let's say that for some reason you have, let's take this particular example, right? Here, this is a double top. You have entered short based on double top. Or no, this is not a good example here. No, I just want to go something. Let's say that you fail somewhere. This is a double top, right? This is a double top, and you have entered. As an example, that you have entered short where price bounces off a resistance zone second time and go. You've placed your stop somewhere above this. Your expected target for whatever. Let's say that you're looking at the next zone of support resistance. Let's put it a little down. Right, this becomes a nice wherever the price has resistance, which turns into support, So what you're expecting is price to move down over here. You've placed your stop here. Now what happens is price generally, for whatever reason, maybe you've misread it, maybe something had happened, price moves up, moves towards your stop loss level. and then you think that, oh, no, 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 there's something over here, this is looking good, it could be just some kind of a price movement. What I'm going to do is I'm going to give it some breathing space. So I'm going to put my stop over here. So what you do is you increase your stop. So you are letting your losses run. Price moves in your favor, say, oh, see, good, I was smart, and then prices move up again. And once it moves up again, then you increase it slightly more. Oh, this looks like a good technical level, price is not going to go above this. You try to convince yourself. Happens a lot. And before you know it, your loss of maybe about $50 or $100 turns into $500. You've let your losses run. And this happens a lot. So one of the first lessons of a trade plan or executing a trade plan is do not move your stops against you. Move them in your favor. For whatever reason, if you have placed a stop, if you have put a stop loss level, have the discipline to stick to it. Conservation of capital, remember that. Right? Now, let's go over a trade plan example. I just want to go over one particular divergent trade that we took, and I want to use that as an example of a trade plan. Let's zoom it inside. This was a bearish divergence. If you look at this, price made high and a higher high, and if you look at your stochastics, they made a high and a lower high. Classical textbook example of a bearish divergence, what we call as a class A bearish divergence. Now the trade plan, when I'm talking about a trade plan, if I was trading this, when I was trading this, we had a trade plan for this. Now the first thing, of course, I follow a couple of systems of 3-4 different techniques. I'll look for harmonics, I'll look for a divergence. But if you have one trade plan, I would suggest sticking to one technique, maybe two for that matter. That I am going to take a trade. Let's take example of a divergence. Only if I see a divergence. If I do not see a divergence on whatever time frame I'm looking at, maybe 5 minutes, maybe 15 minutes, maybe 1 hour, I'll scan my currencies. Let's say I'm trading intraday and I'm trading on the 15-minute time frame. On the 15-minute time frame, I'm sitting there and I scan my currencies all day long on the 15-minute to look for a divergence. These conditions for a divergence, where price makes a higher high, the stochastics make a lower high, right? A bearish divergence. If I do not come across any divergence, I will not trade for the day. Very important. Let the price go wherever it wants to go. Suddenly the euro drops 300 points and I think, oh, I have missed out on the trade. No, you ask yourself that, was this as per your plan? Was there a divergence which moved that? No. If not, you are not supposed to take part of it. There will be more opportunities in the market. This is not the only move. Now this is very, very important, and a lot of traders cannot follow this, human emotions being what they are. But this is the beginning of your trade plan. Decide on a strategy. Say that only if these conditions are fulfilled will I take the trade. If I do not have these conditions, I will not trade. I will not trade for a day. I will not trade for 3 days. I will not trade for a week if required. But only if the conditions are satisfied, or if I get my setup, I'll trade. Now see, what happens here, folks, is in the process what you're doing is, if you're waiting for the conditions, your setup conditions, you are eliminating more than half of your unsure trades. This increases the probabilities of success. Obviously, once the setup conditions are there, your probability of success increases. Right, so what did we decide on a trade plan? Have a strategy first, have a technique. Then you decide on your entry, exits and stops. So here we decided on entry, exits and stops. Let me just go through this. Your stop obviously was placed above this high. Your expected target for this trade, we use the Fibonacci's, we use the Fib 127, Fib projection 127. This was a Fib for projection 127. The entry was based on a combination of different factors, but let's just put it, if I remember correctly, it was somewhere below this bar, little over here. Right? This is what the trade was. We have the entry, you have the stop, you have the expected target. This gives you your risk to reward ratios. Obviously, your risk for this trade was about 40 odd points, and your expected reward, you don't know whether it's going to happen or not, was about 150. Risk to reward ratio of about 1:3, little more than 1:3. Excellent risk to reward ratio. Mm, Ray, I'll just come back to that. It's a very interesting question. Right, so you got your risk to reward ratios. We decided on the number of lots that we were going to trade on here based on the capital. That okay, I'm going to trade 3 lots, I'm going to trade 4 lots, many lots on this. We enter the trade went forward. Now, more very important point is what I generally do is we enter with limit orders. We do not enter with market orders. So we place the entry at that place that if price comes there, we are filled into the trade. Preferably don't want to go in with market orders. You place your orders there, price fills it, you're in the trade. Your stop loss levels are in place, your targets are in place. Once you're filled, it is your trade management. Your trade management is very, very important. See, what happens in this case, price went down, reached a certain level and bounced from there. It pulled back from there, almost back to the entry level. But there are certain techniques that we follow. We were expecting that price will move up from here, and if it stops over here, we are still in the trade. Took some profits over here because this was a pullback point. Took some profits right over here. Let me just remove this. Close some profits over here. Shifted stop down almost to your entry level, close to your entry level. Waited for the pullback, still in the trade. Price did go down in a favor which we were expecting. Now, not all trades really work out like this. And it's not that we were lucky. We were prepared for this trade. Because we knew the certain levels that yes, price is expected to bounce from here. If it pulls back, this is the certain level that if it stays within this level, we are still in the trade. If it goes beyond this, if it would have gone slightly above this, obviously we would have got stopped out since we have shifted the stop, but we would have got out of the trade saying that something's gone wrong. Now, trade management is very important. So expecting, the point is this move up against us did not freak us out. For a new trader who enters a trade for some reason, and he doesn't have a reason, and the trade goes in your favor for some time, and once it starts pulling back, price always moves in waves. The trader freaks out, literally. So, oh, something's gone wrong, let me get out of the trade. He gets out of the trade, and in effect what you're doing is you're cutting your profits. Right? If I would have gotten out of the trade over here, I would have missed out on the balance profits. So what am I doing? I am cutting my profits and letting my losses run. Exactly opposite of what you're supposed to do. So this is how the trade was executed now. As I said, this was a pictured bearish divergence. I just want to go over these examples. Very important to have a plan. Decide on a strategy. Decide on your setup conditions. Decide on your technical levels. Expect price to move up and down and manage the trades. That is the essence of a trade plan. Let's come back to this. I think we have done with over here. If there are any more questions about the trade plan, please do let me know. But it's very, very essential. As I've said in the beginning, I have seen that it is the difference between success and failure, and it's important. Do not underestimate the importance of a plan. You must have a plan. Right? Okay, let's get down to Ray's question. How easy is it for a person to adapt another person's strategy? Does a learning trader personality create a barrier? Yes, Ray. The trader's personality, I wouldn't say create a barrier or problem, but adapting to another person's strategy is not easy. What I would recommend is take any technical strategy. Let's say this divergence. If you want to follow a divergence, you take the strategy of a divergence, build a trade plan around your comfort level. It's very, very important. See, what works for somebody else will not work for you. For the simple reason that person may have more capital, maybe you have more capital. That person may be aggressive in his approach, you may be conservative. You may delay your entries. That trader might take his entries immediately. So what works, techniques, if a technique works for me, doesn't necessarily work for you. You have to adapt it to your own thing. So you do adapt it. Take the technique but adapt it to your technique. Fernando, what is my trigger is you'll have to put some money into my Swiss bank account to tell me that. Well, very frankly, this is part of the divergence trading. I cannot really divulge it over here because this is a part of a course that we do. Is we have taken divergence to the next level. what is the setup condition, and this, how do you identify the best possible divergence? What is it that decides on your entry? Where is your stop? What is your trade management? There are other tools which we have which determine the trade management, which tells us that the momentum of price is indeed in our favor or not. Okay. Boyki, a journal is very, very important. Not after trade, you must have a journal for your trade, for your analysis, as well as for after trade. Believe me, I have got my journals from 10 years back. Sometimes I look back and I see what I did about 8 years back, and I say, what the hell? I mean, I was foolish. I mean, how the hell did I manage to do that? But it's very important, because your analysis, what you're thinking, has to be put down on paper. When you look back on it, and of course you can't just write it and throw it away, you go over it, spend time, learn from your mistakes. Even if the trade goes in your profit or in your favor, you get profits, you have to write it down saying that, okay, I took a trade based on this, it went well, it did not go well, did it go as per my trades? Having a trading journal is very, very important. It really is. It makes a lot of difference. Linda, yes, I find the stochastics of 955 better than the standard 533 for the simple reason the 533 generally tends to give a lot of whipsaws. I find it gives false movements. Now, I use the stochastics only to determine a divergence. Right? It depends on what you use the indicators for. If you're using it for oversold overbought levels, then maybe 533 will work better. But for me, I do not look at anything else, not oversold overbought levels, not crossover of signal lines, only to identify a divergence. For that, I have seen the 955 gives me the best parameters. Alright, folks. If I may, a piece of advice, both the RSI and the stochastic, Linda, are the same. See, any indicator which is banded between a value of 0 to 100 is, they are called as oscillators. RSI, stochastic, MACD, CCI, momentum, they are all oscillators. They give the same thing. If you are going to be using the RSI and the stochastic only to look at oversold overbought levels, there is no need for you to use both indicators. One will be more than sufficient, much more than sufficient. Rakesh, it depends actually. I generally trade higher term time frames, 1 hour and above, 4 hours, maybe even daily. So it just depends on what it is. But I generally prefer higher term time frames. No, Ray, I do not use moving averages because I frankly consider the moving averages to be one of the most lagging indicators. That's exactly the point, Linda. If your RSI at 7 instead of the standard at 14, see, your indicators are always lagging. Yes, you can use it correctly, but see, what are you using it for? RSI at 7 gives a movement much quicker. What are you looking for? Are you looking for a change of trend? Are you looking for oversold overbought levels? No, you're welcome. See, it's change of trend. Yes, and if I may suggest, RSI, yes, but use the stochastics more to look for a change of trend. And RSI, even at 7, will definitely give you an earlier movement, but RSI, not very effective for a change of trend. It's much more effective for a breakout. This is what I believe in. The RSI stochastic is a pretty decent indicator, Rakesh. Right. What we'll do, Linda, is sometime subsequently, I did one session on the use of indicators. I will be taking up one session sometime on the use of RSI, the best use of RSI. And if you want to send me an email, I could give you a heads up when I'm going to do that. And I'll give you a good use for the RSI. It is the way I believe it. See, everybody uses it differently. It's a very personal thing using indicators. But I could just give you my inputs and see whether you like it or not. That'll be fine. Right? Yes, Ray, of course. Candles are very, very important. Looking at, let's say for a divergence, if you look at this particular example over here, what you looked at, that there was a nice hammer at the divergence. Candlesticks do give pretty decent confirmations. I don't use it in isolation, but if against a level of support resistance you get a candlestick pattern, it only increases the success. Worky, I do not trade the economic data releases, one, and if I'm in a trade, shorter term trade during important news releases, I either tend to take profits and shift my stops. If the trade is not too much in profit, I may probably close it during important economic data. I don't want to get caught in the whipsaws what happens during the economic data. It's post-economic data and price settles down that I would look to enter again or re-enter the trade, because that is where your levels of support resistance come into play. Yes, of course. Ray, I think we did a session last week or the week before last. We recorded that session on the use of time frame and the rule of 3 for time frames. It's available on the FXStreet website. If you just go through it, if you go through my profile and my webinars, very important to use different time frames for analysis, higher term time frames. Right, folks, this is my email. In case anybody has any other questions, please feel free to get back. I'm always available. There you go. Well, alright. I hope that this was an interesting session for you to understand the importance of a trade plan, and I do hope you do have a trade plan. I hope that most of you do have a trade plan. If you don't, my advice would be write it down. Make a plan for whatever. As I've mentioned, it doesn't have to be complicated. Put down these 4 points. What is my technique? Where's my entry? What's my stop? What is my expected targets? And what are my rules for management? Period. Don't complicate things. Alright? Alright, folks, so I'll see you again for FXStreet sessions. How long does it take for a trader to become comfortable? Well, that's a very difficult question, Ray. It's very individualistic, if you can call that. But do an experiment. Let's put it this way. Let's do an experiment. If you want, I've given you my email address. Make a plan. Whatever. Very basic plan. Send it across to me. And I'll just refine it for you if you want. Make some certain changes for it. Follow the trade plan for 1 month. If you have the discipline to follow your trade plan for 1 month without deviating from it, you'll see the difference in your own trading. And then you can answer this question on your own: for how long will it take a trader to get comfortable with this? And this is for everybody, folks. If you have a trade plan, if you have the discipline to follow it, put it down in writing, follow it for 1 month, 20 working days. That's it. And have the discipline to follow it to the T. You'll understand the importance of it. Absolutely, Boyki. I'm not more technical. I'm only a technical trader. Fundamentals, yes, we do keep it in mind. I prefer looking at currencies whose longer term outlooks may be bullish or bearish, but primarily my entries or my trade decisions are technical, not fundamentals. Alright, folks, so I'll see you next week. So have a good trading week till then. Have a great trade weekend, and good being over here. If you have any questions, as I said, please feel free to get back, and I'll see you all folks next week. Thank you very much. Well, thank you, Forex Lady. Not a problem. You're more than welcome. My pleasure being over here. Alright.